Hi guys, welcome back to my channel. Is the US economy at the risk of recession? Are the economic indicators pointing towards a recession? Is Fed too late in cutting down the interest rates? Will stock market continue to crash from here, or the economy will achieve a soft landing? These questions have been doing round and creating fear-led volatility in the stock markets for quite some time now. So let's decode this economic dilemma, separate the noise from what makes sense, and figure out what is the cause-effect relationship between various factors in play and what is the probability of US recession. In June 2019, the inflation in US touched 9.1% for the very first time in 4 long decades. To combat the surge in prices, Fed had decided to hike the interest rates between 2021 and 2023. It increased the interest rates 11 times, taking 0.25 to 0.5% to the benchmark rate of 5.25 to 5.5% levels, taking it to 23-year high. Two indicators which predict the beginning of recession are cooling job market and inverted yield curve. The unemployment rate in June was 4.1%, which rose to 4.3% in July 2024, which was a 3-year high. Though this rise in interest rate has eased inflation, bringing it down to 2.9%, which is barely higher than the Fed's long-term target rate of 2%, it has still slowed down the job creation in US. Official data showed employers barely added 114,000 jobs in July, which is far fewer than expected, by the way, while the unemployment rate rose to its highest levels. While this may be low by historical standards, but the 3-month average unemployment rate has sailed past the lowest 3-month average in the last 12 months by more than 0.5%. This, in fact, is SAM rule in operation, which in US is held in high regards as a likely indicator of onset of recession. The figures also suggested that the long-running jobs boom in US market might come to an end. Job gains have dropped below the threshold level of 150,000, which is considered consistent for a solid economy. Besides this, the wage gains have also slowed down, with an average hourly pay rising by just 3.6% in the last 12 months. Now let's talk a bit about the inversion of the yield curve. In normal economic scenarios, we see an upward moving yield curve, which indicates higher yields for long-term fixed income instruments. The inverted yield curve signals a pending recession in the economy and suggests that the investors are wary of the long-term outlook of any country. Hence, the yields offered by long-term fixed income instrument is expected to continuously decline. The US yield curve is showing a similar inverted trend, with 1-year bond yields, that is 4.1%, being higher than a 10-year bond yield, that is 3.7%. Rise in interest rates has made borrowing expensive, leading to fall in business as well as consumer spendings in the country, which in turn leads to crunch in demand for laborers and a further rise in unemployment. Having discussed all of this, there are many out there who still believe that not all economic indicators are actually signaling to a recessionary trend. For example, US economy is growing at an annualized growth rate of 3% as per Q2 of 2024, which is a bit higher than 2.5% in 2023. The corporate profits have also continued to show an uptrend with no sign of margin erosions. In fact, the US economy has grown faster than the other G7 nations post-COVID. Most recessions occur because the overall economic output, also known as GDP, falls notably. That has not yet happened in the US economy and does not look like it will imminently. The credit card spending too has shown no considerable mark of sluggishness. However, the delinquency rates on car loans and credit cards have risen, especially among lower income households. But they are not yet up to the levels of 2008 financial crisis. Data shows that young borrowers and those living in low income areas have maxed out their credit card capabilities, and more than 40% of people have used their more than 60% of credit taking capabilities. Now, concern really is whether US consumers can continue driving the growth even after unemployment is rising and savings built up during pandemic are dwindling. For the Fed, the decision comes down to deciding which is a bigger risk. Either it is reigniting inflationary pressure if they cut the interest rates by 50 basis points, or threatening the recession if they only cut it by 25 basis points. I personally think that jittery investors have overplayed the threat of recession. Based on a holistic set of employment unemployment and economic output figures, it doesn't show any clear, consistent and secular declining or recessionary trends. While Fed has indicated a rate cut, knowing the fact that economy has slowed significantly, it leaves less of a buffer for Fed to experiment in the event of further hit to the growth. Inflation is still higher than the targeted rate of 2%, and if these temporary price hikes are ignored, they could leave Fed with some real hard times in the months to come. Thanks for watching this video. If you liked the video and found it useful, do tap on the like button and drop in your valuable comments and feedback. Do subscribe to my channel for more such content and share it with your friends. I'll keep coming up with more such insightful videos for you all. Thank you so much.